Welcome to Argus Metal Movers, the podcast where we dive deep into the latest trends and developments in the steel market. I'm your host, Elif Eyüboğlu, steel market reporter at Argus Media. Today, we have a very special guest, Jason Zhang, our lead analyst at the Beijing office, who will share his insights on the current state of the Chinese steel industry. We will discuss the latest price fluctuations, changing exports and domestic market dynamics, and what the market expects regarding the future of the Chinese long steel industry. And hi, Jason. It's very nice to have you here. Could you start by introducing yourself?
Yes, hi Elif. Thanks for inviting me for this podcast. I have been covering Chinese steel market and Southeast Asian import market for almost 10 years. And today I'm going to cover some topics regarding the hot issues market participants are interested in now. So can we begin now?
Sure. Thank you so much, Jason. My first question to you. China rebar export prices range between around $455 to $465 FOB in the early second quarter, but then fell below $440 in June before rebounding sharply in late July to $465 FOB. Prices stayed firm through August despite the seasonal slowdown, and was this mainly due to cost side support like rising coking coal prices, or were there other factors as well?
Thanks for the questions. Yeah, I think the main driver was higher coking coal cost. From July to August, China's coking coal prices jumped by more than $50 per ton. And compare with only about $20 to $30 increase for rebar. So that meant that even though steel prices were going up, mills' profits were actually falling because their coal cost were rising faster. Another factor was a broader trend of clearing out outdated capacity in China. That policy has been pushing up both coal and steel prices. So far, mills haven't been given any clear production cut targets, but some in the market expect possible restrictions in quarter four, especially during the winter heating season in northern China. Remember back in 2016 to 2020, the government used to mandate production cuts for sintering and blast furnace during those years.
And there was a price hike in mid-August following Tangshan production cuts and a brief China-US tariff suspension, but prices fell after the new US tariffs on 18th of August. How did these measures affect export sentiment and pricing?
Honestly speaking, the tariff did not affect China's steel export very much. Yes, there have been plenty of anti-dumping investigations and new tariffs this year, but China has found ways around them, mainly by shipping more to open markets like Middle East, Africa, and Southeast Asia. Another big shift is billet. China boosted billet export sharply this year, since most countries don't impose anti-dumping duties on semi-finished steel. If you look at China's export data, this trend really stands out. The main factor affected China's steel export sentiment and pricing is its local demand and local prices. Usually, when local demand is weak and local price is falling, mills prefer to export more, as its export prices will become lower and more attractive for global buyers. You can also see this trend from China's rising steel export from the second half of last year, when Chinese local prices started to drop quickly due to weak domestic consumption.
How are the rebar and billet exports looking ahead? What are the market expectations for Chinese rebar in the seaborne market?
Yeah, I think looking ahead, participants expect the overall trend is a gradual decline for China's total steel export. And our survey shows that steel mills in China received fewer bookings in August and September compared with June and July. Since there is usually a 2 month gap between bookings and shipment, we are likely to see export drop in October and November. And but the outlook really differs by products. For flat steel, things like hot rolled coil, cold rolled coil, and galvanized coil, I think export will stay strong. Chinese flat steel remains very competitive globally, even when prices rise, because it's hard for buyers to find another supplier that can consistently meet their needs in terms of the sizes, specifications, volume, timing, and customization. Sure, some buyers may turn to local mills or India or Turkey or other major exporting countries, but it is still tough for them to fully replace China in terms of flat steel production and cost control. But for rebar and other construction steel, it is a different story. Rebar buyers are extremely price sensitive. Back in 2021 to 2022, when Chinese rebar was over $800 per ton, export dropped a lot, and Southeast Asian buyers switched to suppliers from Middle East and Turkey. The global rebar market is much more saturated than other flat steel, and producers mainly compete on prices. And right now, China can still export at around $460 per ton for rebar. But if local prices rise above 500 in Q4, rebar export may drop, obviously.
And Chinese billet export prices also moved, but overseas buyers have shown limited interest in higher offers. And as you mentioned, has the billet export market faced a similar resistance as the rebar? And are mills adjusting their export mix or pricing strategies accordingly?
Yeah, from January to August this year, China exported over 9 million tons of semi-finished steel, or we may say billet. To put that in perspective, in just 8 months, export have already topped last year's full year total, around 6 million tons. But the challenge is the same as a rebar and other Chinese steel products. Once prices go higher, buyers quickly lose interest. And with billet, the sensitivity to price is even sharper than with rebar. Now we may see a record year for Chinese billet export. That is simply because prices are also close to almost a 9-year low. But at the same time, billet isn't really a stable or sustainable export product for China. For example, in 2022, China only exported 1 million ton of billet, when highest billet price was close to 700 per ton. But China still exported over 4 million ton rebar that year. So overseas buyers aren't very interested on Chinese billet right now, and mills are very well aware of that. The difference is mills don't feel any pressure to maintain a certain export volume of billet. It really comes down to local prices and demand. At this moment, domestic consumption for billet in China is still holding up pretty well, and foreign bids just aren't very attractive for Chinese mills. So that's why most participants expect Chinese billet export to fall in September and October.
Well, that will be very interesting. I have another question about the production routes, and there is an ongoing discussion about China's possible routes for steel capacity exit and the role of the electric arc furnace mills. Do market participants expect a shift towards the EAFs, or what would that mean for iron ore demand and its influence on steel pricing? And most importantly, how do you think this will impact the domestic market, or it will rather create a shift from
Mhm.
exports to the domestic market as well?
Yeah, traditionally Chinese mills they prefer uh, to to produce more steel from blast furnace rather than from EAFs. One key reason is scrap. Unlike in Europe or in the United States, their scrap supply is very abundant. China's scrap recycling industry is still in its early stages. That means steel mills have to rely more on iron ore. And on top of that, EAF production in China is simply more expensive. The cost is usually $20 to $40 per ton higher than blast furnace or BF mills. So as a result, most EAF mills are actually losing money right now. But some BF mills still have a slim profit margin. But the policy is coming into play this year. Starting in March 2025, China's Ministry of Environment is bringing steel, cement, aluminum into the national carbon emission trading system. That means small private steel makers could face much higher cost to control carbon emissions. Some participants believe that will be a market-driven way to push weaker players out rather than giving a direct shutdown orders. And at the same time, we may see more consolidation in the industry. China's top 10 steel makers had a concentration ratio of 34% back in 2015, and it is climbed to about 42% in 2024. That is the progress, but still below the 65 to 85% levels we have seen in developed countries. So looking ahead, I think Chinese mill still expect to rely heavily on iron ore. Now the daily hot metal output is around 2.5 million ton per day for hot metal. The data is from the market participants. And in fact, I think a firm iron ore price isn't necessarily bad because it can help to support the steel prices, especially when Chinese local demand is weak. Imagine if Chinese iron ore import prices collapse and steel prices can only fall more, and mills keeps producing more because after iron ore prices become cheaper, their profit actually turns better, so the oversupply continues, and the whole cycle drag the market down until everyone is losing money. But if iron ore prices can stay strong, mills are forced to cut output when steel making becomes unprofitable, and that can actually help rebalance supply and demand and keep the market healthier in the long run.
Well, a big thank you to Jason for sharing his expertise with us. And thank you for joining us on this episode of Argus Metal Movers. And we hope you found our discussion on China's long steel market insightful. And if you'd like to hear more about Argus Media and our steel product, Argus Global Steel, please get in touch with us. And thank you.